Welcome to Stockwatch with me, Ray White. Well, joining me to unpack your stock-related questions today are Kearabilwe Nonyana from PRIMEXBT and Cobus Potgieter from Southern Cross Capital. Be sure to send your questions, though, via email to stockwatch@bdtv.co.za, via SMS on 41392, or on X on Business Day TV using the hashtag Stockwatch. Gentlemen, good to have both of you with us today. Kearabilwe, I'm going to start with you. I mean, US tech stocks, where do we go with those? I've got so many emails that have come in and people are like a little bit baffled about what's going on. We saw what happened on Friday. Monday's been no different. What's your take?
Yeah, I think the market has tried to almost anticipate and find an edge on these AI stocks. And I think sometimes you just have to come back to reality. And I think for me, it is the market trying to see which parts of the market are going to become obsolete because of this new AI technology. And suddenly during trading days, I think there's just some fear which creeps into trading desks, and people try to anticipate exactly which industry is going to become obsolete and start selling off those stocks, and then it kind of just tapers on into risk off assets, and it just becomes a sort of a groundhog day almost every day since last week Tuesday. And I think the reality of it is that it's going to take a while before we start to see the obsolete industries really being affected by AI, and the market is trying to anticipate that. But for me, what we can look out for is there's almost $700 billion which is going to spend on capex. If I told you today in South Africa the government or any business is going to spend 700 billion, what you would anticipate is that it's going to filter down into the economy, and that spend is going to become a value accretive for everyone, and everyone is going to benefit. And I think right now order books are looking strong in terms of these AI counters, and I think the market should just really take a chill pill and just start looking for value in some of these stocks which have been sold off.
All right, Cobus, do you agree? Should the market take a chill pill?
I love that sort of Keynesian view, you know, there's all this pent-up spending coming, ergo growth. Look, it's I'm seeing a lot of absolutist opinions saying, you know, some of these software as a service companies specifically, which is the most threatened model. These companies are going to go to the way of newspapers in the early 2000s in the wake of the establishment of the internet, and that's perhaps, like I said, that's a bit absolutist. We've yet to see how this will evolve over time, and a lot of market participants are also taking the view that ultimately, once these companies start employing AI in their processes, it might actually end up being value enhancing, and their brands are strong, and their enterprise offering is strong, and the likes of something like SAP is doing very complicated software, which might be difficult to vibe code. Yes, it's up in the air. Perhaps this is overblown, but there will be disruptions, and the market is trying to price those changes. And I wouldn't say, even though the news has been absolutist, the market movements have not. And this model, it has perhaps been a little bit too lucrative, and there should be some sort of an alternative, or you know, a potential bombshell disrupting those models. And some of the same companies that have been investing heavily into AI, LLM development specifically, are the ones whose business might be potentially cannibalized. Think Microsoft as the prime example. So I understand that there is some uncertainty, and we can't believe that AI will create all of this enormous value without acknowledging that there are segments of the economy that might end up being replaced by cheaper alternatives.
Yeah, okay, no, fair enough, Kearabilwe. You are also nodding your head there as well. When you said the word cannibalized, you were like, yes, they're going to be cannibalized.
Yeah, I think that's what the market is fearing right now, and you can just take the example of Microsoft and essentially look at some of their business, their software development business. I mean, if essentially they're one of the biggest AI spenders, and it might just lead to one of their business becoming quite obsolete. But I think for me, my worry comes at the opportunity cost of this big AI spin. Because I mean, there are some businesses with the stables of the Max 7, which are value accretive right now, and because of such high capex spend, they might be taking away resources from the businesses such as Azure and Microsoft, which I think could really expand right now and give value right now. And I think that's what the market is fearing at the moment.
That's interesting. All right, something else I'm seeing quite a few emails coming in on is Telkom. And I'm loving the fact that Telkom's winning. It's been the big success story. If you have a look at some of their counterparts, if you look at an Eskom or a Transnet or those kind of things, the old Telkom there's nothing old about it. It's doing so well, Cobus.
It's almost a perfect turnaround story, and to some extent, a lot of what they're doing in terms of cost control, and the simplest thing, I mean, this business owns way too much property. What business do they have, given the direction that they are going, owning all of this property? And we've seen Telkom go through a few iterations of, rebuilding new management teams through the years. Why is this only being executed now? But it is great in terms of the hypothesis that they've sold off, 600 million in property in the last year, with another 400 million coming up. You're seeing that enormous campus in Joburg coming up to auction this week. And then on top of that, of course, forward-looking, OpenServe data, those businesses really, mobile data specifically, really thriving, with the likes of BCX and the historical business doing less well. But ultimately, it looks like they are executing pretty well on the turnaround play. And of course, the possibility of corporate action in the mobile business specifically, that still remains part of the thesis. And this looks like a really good trading update, and we're seeing it as the second best performing stock in the exchange today.
Yeah, Kearabilwe, what are you seeing at the moment? Are you seeing the same thing? Are you thinking, oh, success story?
Yeah, I mean, I do like Serame Taukobong as the CEO. I mean, he's a wily operator and is really just coming around and turning this business around. But for me, I always get concerned at the South African business, which I think is quite ex-growth, even though they are growing their mobile data, which means that they essentially are stealing some market share, in my opinion. Because when you look at the top line growth for South Africa for Vodacom, so Cell C's update also came out on market on Friday, and as well as Telkom coming out. Their revenue growth numbers are like 1%, 1.8%. And I mean, you can control costs for as good as you can. For as long as you're not growing top line, you're going to have a bit of a problem. And I think maybe that is why I did not take any position on it last year when it did do so well, Blue Label, Vodacom, and MTN. But I think its concentration into South Africa is what really concerns me, and I think there's just better players out there like Vodacom, who has their business in Egypt and as well as in East Africa, which is not ex-growth like South Africa.
Yeah. What then is your take on Cell C? I mean, they were last week Friday, and they seem to come out guns blazing, or is it still too early to tell?
It's still too early to tell. I mean, it's thinly traded. I mean, it's one of the stocks where there's really no liquidity on it, and it was their first interim results which they came to the market about. Also, it talks of a turnaround, and it was just merely the recapitalization after the listing, which really favored the numbers more than it should have, because it was in a loss-making position. As I said, I worry about the top line growth, and if you had to compare the operating margins right across all these businesses, I think their operating margin was at 16%, Telkom just north of 25%, and then you look at MTN and Vodacom, which are north of 35%, which tells you that the model they're running, essentially being a piggyback network because they sold off their towers business, it really, I think, just depresses margins in an environment where government is also looking to reduce the cost of data.
Yeah. Cobus, you were kind of shaking your head a little bit there when I said Cell C. See for yourself.
No. The capital structure has only been finalized now, so these numbers are funnies. We'll have to look forward before we can really read into the actual profitability. But I agree, we've got a number of players, higher and lower quality, fighting for the same probably shrinking pool because of the pressure from government to reduce the cost of mobile, reduce the cost of data over time. But call it the virtual ISP model does seem to be capturing significant market share through their partners, Capitec, which we should also chat about today. So there's these things. I mean, just because the top line isn't that attractive doesn't mean as sort of a cigarette stub type trade there isn't enormous upside to be had.
Yeah.
And this could potentially be a similar story to Telkom off of that basis.
We will get to Capitec a little bit later on. I see I've got one or two emails that have come in on that, but we'll get to that shortly. Kearabilwe, what about talking about bonds, the bond market now? And it's been Business Day's big story of the day. That's for government, but the bond yields are looking a lot better. What is your take?
Yeah, I think when you look at the statistic, there's been record buying of our bonds, but by foreigners first of all. And I just think looking at the carry position in terms of having such good yields on our local market, it really was just an opportunity cost that I think the market globally could not really overlook. I mean, term premium for a very long time, for up to 3 years, was really so positive that at the moment you could not overlook being in SA bonds. And if you're looking at the fiscal position, also consolidating, looking at the debt stabilization, we've had 3 years of primary surpluses in terms of the fiscus, and as well as getting to a stage where the government is looking at its debt position. So for me, it was a no-brainer being in SA bonds at the moment.
Interesting. Cobus, your take?
I looked at the 2035 yield this morning, and since 11 months ago, it's just been a straight line. You could fit a perfectly straight line and predict where the yield would be the following month. Phenomenal, and the flows have been incredible. Like Kearabilwe said, foreign buying primarily. Where the value sits is difficult to say. I suspect the further pressure on US rates is also supportive of that yield-seeking behavior. And clearly, some major players have taken the view that South Africa's prospects are rosy, and our estimates for GDP growth are too pessimistic. But I wonder why this isn't showing up in equity valuations. And the banks, which have historically been highly correlated to bonds, are not nearly as performant enough to reflect this new rosy outlook. So either the bond holders are too optimistic, or the equity holders are too pessimistic. Where in the middle they will meet, I'm not certain. But this cannot hold forever.
Sure. All right. Some questions for you, gentlemen. Kearabilwe, I'm going to start with you. Morris says, what is your take on Bytes, please? That's from Morris.
Bytes Tech, I mean, it's a small counter. I really don't cover it much. I mean, it's in technology and as well as hardware. So not a counter I cover much.
Okay, Cobus, are you keeping an eye on Bytes or not really also?
Look. Maybe I'm a dyed-in-the-wool South African investor, but we tend to shy away from these very highly rated technology stocks. But this is a very well-loved name in the overseas market. Trades more in London than it does locally. And I mean, I think every single analyst that covers it thinks it's a buy. At this stage, people are very bullish, specifically on the IT security story, thinking that, again, it's another AI story. As AI ramps up further, as virtualization and cloud becomes bigger and bigger, as more enterprises adopt this technology, to which they are also exposed, but they are specifically very exposed to security, IT security, and that seems to be where a lot of the optimism is coming from. But the operational performance has been pretty disappointing over the last few years, so it's the share price is quite depressed. These sell-side analysts are screaming that they think it's a buy, but the market at this stage doesn't agree with them.
Okay, well, there we go. Morris, that's the lowdown on Bytes Tech. Nelly, Netcare saw gains on Friday. Are they solid? And is there anything that we need to know about? Kearabilwe, you're shaking your head. Netcare?
Yeah, I don't like to be in regulated sectors like this, and I think the cost of medical access is quite regulated. But I mean, if you had to compare the two between Life Healthcare and Netcare, I think Netcare is a better operator. I mean, Life has better occupancy at about 69% versus Netcare at about 65%. But when you're looking at all the other metrics in terms of return on equity, Netcare does better. You'd see at top line revenue growth, Netcare has slightly done better than Life Healthcare. And in terms of EBITDA margins, also Netcare really is a wily operator. And I think right now, if looking at both of the evaluations, when you compare them across their peers, I mean, Mediclinic will no longer have it as a listed entity. You're probably finding that Netcare's valuation sits at a sweet spot where it does become a buying opportunity.
Now, there we go. Cobus, a buying opportunity, yes or no?
A little bit boring. The number of insured lives or people on medical aid has remained constant in South Africa for the last 10 years because GDP growth has been flat, which means there's effectively the pool of possible clients from a private hospital group's perspective has remained flat. And they've resorted largely, Netcare specifically, to just fixing up the business and optimizing it as much as possible, looking to squeeze the margins harder, slowly moving away from so-called network business where you are a Delta network or all of these things, whereas Life has embraced those more actively, looking for volumes. I also prefer Netcare, but I don't like the sector as a whole.
Yeah, okay, there we go. Divided opinion, sort of. We Buy Cars has strengthened today, says one email. What's your take on their stock? Cobus, I'll start with you this time. We Buy Cars.
There's a lot of speculation around the founders selling out, but it looks like that partial sell-off that they did was essentially to try and fund a new opportunity in the acquisition of RMH's property assets along with Atterbury. So that explains it somewhat. And I think given that negative signal from that the market took badly, some of the other executives or board members have actually been buying substantial amounts of shares. It's I like the model. I think the more it scales, the better the margins become. There's a lot of consolidation yet to come in the used car market, but they have gone through a bit of a purple patch, and a lot of the cheap Chinese entrants, a lot of the excellent NAAMSA growth numbers we've been seeing, those are all new vehicle sales, are from cheaper Chinese brands, even though the other brands haven't been doing as poorly as the narrative they like to create when looking for support from the government. They're still up in unit terms over 12 months, but those Chinese competitors have probably been they're so cheap, they're having a substitutive effect in the second-hand market, which in the short run puts a bit of an overhang on We Buy Cars, but in the long run, it'll create more stock for them to be proactive and down the line. Yeah. So I'm a little bit uncertain around current valuations, but we still like the business. This is probably a decent enough entry point into it, given that it is still quite down off those lofty highs.
Right, there we go. Yeah, Kearabilwe, last year I think it was, around about December, they went through that, like Cobus called it, that purple patch. Where do you see the most of the brothers selling off their stock lately? Where do you see them?
Well, for me, I always say that you get a better understanding of where the sentiment is by the board or the owners buying stock and selling it. Because, I mean, there could be a myriad of reasons why they're selling off on some of their stock. They could have tax liabilities. They may be wanting to buy new yachts. Who knows? They've made a lot of money from it. But I think for me, I was reading a sell-side research report on We Buy Cars. And what this analyst was saying was akin to South African retail buyers being more like value investors. And as Cobus said, there's a structural shift in what the Chinese brands have really given us in terms of the entrance and the price point that they've come in at. And I think maybe there might be some structural change in the second-hand buyers market. But when we're looking at all the numbers, it's all new car sales since September. And I think for me, that's where I think there might be some risk in terms of this business model. I know Cobus likes it, but I'm a bit skittish right now in terms of the risks that the structural change might be bringing to the system, and looking at Chinese car brands even now starting to assemble some of their cars in South Africa, looking to buy out the Nissan factory in Rosslyn. I think for me, it may even bring prices even further down.
That is so interesting. That you are so right there. So very interesting. Those Chinese cars have come in and you can afford them, versus the upper end cars. All right, let's park that one then. Excuse the pun. Capitec. Now, Cobus, you wanted to speak about Capitec, and I've got Anonymous here. It says Capitec has been the blue-eyed boy of the banking sector. Will the new kid on the block, such as Pepkor, end this? Now, Pepkor's got their banking thing that they want to start launching and all the rest. What's concerning you about Capitec?
Oh no, I like Capitec. Nothing.
Okay.
It's generally exposed to the SA consumer. We had a trading update last week, so that was interesting. Looks like 20 to 25% HEPS growth over the period, without a lot of detail on where that HEPS growth actually came from, but they did reflect on what they are seeing in these so-called value-added services. So they sell credit life, they sell insurance, they sell SIM cards, they sell data. And one thing that they specifically alluded to, because I think we sort of imagine them just distributing into their existing network of clients. But when my bank sends me an email, hey, would you like a SIM card? I'm not going to necessarily react positively to that sort of solicitation. So what they specifically allude to is when people come and take out a new loan or renew an existing loan, roll that loan forward. It's at that point of engagement where they get the opportunity to increase the exposure to those value-added services, and they seem to be alluding to the fact that they are executing very well on this. So that part of the narrative seems to still be holding up, valuation notwithstanding. And if we are bullish on the South African consumer over the next couple of years, and we are, given that rates are coming down, so are likely to come down further. Inflation is entirely benign. I think Capitec's prospects remain pretty rosy, and I'm not that worried about the disruptors at this stage.
Kearabilwe, are you worried about the Pepkor disruptor or the other ones coming in biting at their ankles?
I know they're so far ahead right now. I mean, it's really comparing apples with nails, really, when you compare Pepkor to the value proposition Capitec has. Distribution matters, as Cobus said. For me, Capitec already has distribution. Pepkor does have distribution through their stores, but I mean, because Capitec has such a long leadway to being running their business and making it as efficient as it is, I mean, the simplicity in their business is what really, for me, sets them apart from everyone else, and how they're able to contain costs. I mean, when you look at the cost to income ratio of Capitec in comparison to its competitors, it tells you about why they aim for digitization and as well simplicity in product type. And these value-added services are just really helping grow the service revenue as well. I mean, I looked at when the price to earnings ratio peaked, and I think it peaked in about 2021, 2022 at about 50 times. And it just has just been churning out earnings and just going into that valuation. And if you haven't been in the stock, you've really not done well.
All right. While I've got you there, what is your stock pick this evening?
Yeah, my stock pick is Naspers, and that's just on the back of the fact that it's just been sold off so much at the moment. I mean, there's a time where you start seeing a share and you're just like, no, this is too cheap. I've never seen Naspers at these rates, and it is just purely because Tencent has been selling down in China on the back of the fact that they do not believe, the market does not believe that Tencent is spending a lot on AI and may be falling back in terms of its consumers, and the strong rand hasn't helped with that as well in the valuation. So right now, Naspers is my pick, and that's just because Tencent has been selling down, so Naspers has also been selling
right,
down.
Naspers it is. Cobus, what's your stock pick?
Sanlam.
Okay, interesting.
I think just I guess continuing along with my narrative before, where the SA Inc. stocks have been lagging the banks or the bonds. The banks have recovered somewhat in the last quarter of last year and the first quarter of this year, but the insurers remain remarkably cheap. So as a sector, we like them overall, and in terms of execution and valuation, we like Sanlam in particular. We find that they are better at integrating the different business units and not having them not compete with one another, but distribute into one another. The cross-selling is incredibly effective. We like the fact that they've divested from SIM and have this arrangement with 91. We think there's a lot more potential there. And ultimately, you're getting exposure to both this SA business, on which we are more bullish given the metrics, and what looks like a pretty interesting fledgling business in India as well. So it's a very good operator in a sector that we like.
What an interesting conversation we've had. Gentlemen, thank you so much to both of you. Good to have you with us on Stockwatch this evening. Thank you so much. And that's all for Stockwatch today. Thanks to our guest, Cobus Potgieter from Southern Cross Capital. Also thanks to Kearabilwe Nonyana from PRIMEXBT. Up next, The Close.